All right, give us a couple seconds here to set this up to record, and we'll get going. All right, thank you everybody for joining us today. This is going to be a great strategy to implement in low implied volatility environments, which is what we're experiencing right now. So this is going to be a good opportunity for this type of trade, especially with market at historical highs here. This could really prove to be quite profitable if the Fed ends up raising rates in a lackluster economy at best. With the economic data we've seen coming out lately, it could really start sending the markets down. Anyway, let's get on with a couple of things I got to get out of the way. My name's Eric Wilkinson. Some of you may recognize us from CNBC, Fox Business, the Wall Street Journal, for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I actually started trading in college and started out with a psychology degree, switched it over to finance after starting to trade, and then upon graduation moved up to Chicago Board of Trade and got a job on the floor, started trading thereafter. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you learn to take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. Somebody else is doing your risk adjustments and your trading for you. At the end of the day, they're going to make the same mistakes as you guys. I mean, we can see like Goldman Sachs and stuff like that getting out of positions at the most inappropriate time, and you know, sometimes they're talking about buying calls at the wrong time. So especially according to a lot of the research and floor experience I've had, it doesn't make sense. So if you're paying somebody else to do it for you, a lot of times they're going to be making mistakes that are going to cost you guys money, and you might as well do it yourself at the end of the day. Would I tell you about my trading room after the class, Bobby? Yeah, absolutely. Just remind me, because it'll probably scroll off by the end of all of this. Anyway, like I said, I started trading in Chicago from the Board of Trade, and in that time I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions, you guys. So I've been there, I've done that, I've seen it happen. So, you know, on the floor you see all kinds of things going on, and that even goes back to watching Goldman Sachs go out there and throw out a statement on CNBC that was completely counter to the position they were trying to put on in the pits, just as an FYI. So you can't even always listen to the talking heads, because they sometimes have a different agenda. Anyway, this disclaimer says any opinions, news, research, analysis, or other information contained here are material provided by ProTrader Strategies, associate companies, or employees, is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any securities, contracts, or anything of that type. The reason why is because, you guys, I don't know what your risk parameter is. I don't know what your investment knowledge is. I don't know what's in your portfolio, and therefore what I'm talking about could be counterintuitive to what you are already doing or exceed your risk parameters. So take all of this into account before you know, pulling the trigger on it. And one other thing is if you have the opportunity, play around with some of these strategies in a paper trading account before you start implementing it into your real account. And remember, the past performance of any trading system or methodology is not necessarily indicative of future results. So this is going to be a strategy where we're going to be putting on a long put spread and building that out. And yeah, it is one of the more basic strategies to implement into a portfolio, especially when you're getting into options. So even the savvy options trader can actually learn something from this. This is going to be from, you know, my 20+ years of experience on the floor trading, and these are some of the things that the floor traders would really migrate towards because of the increased probabilities of success. because anytime you're doing a debit spread or paying for an option, your probabilities of success are much less than if you're selling options. So I've done a lot of digging on this throughout the years and come up with some really good ways to increase the probabilities of success. So with a long put spread, there's two ways to build this out, and I'm going to talk about both of them. One is buying the in-the-money put, and then you're selling an out-of-money put. Now, the in-the-money put is going to be the 84 delta, and the reason why we're looking at that 84 delta for the in-the-money put, if we're going to build it with that one, is because it's a 1 standard deviation away. It means 84% of the time that put is going to remain in the money. And then we're going to try and sell an out-of-the-money put when we're doing that to finance the extrinsic value of that option. And I'll go into more detail later on, but intrinsic value is what is the real value of that put. The extrinsic value is what is going to decay and become worthless at expiration. So by selling that out of the money put, it is all extrinsic value, and we're going to try and finance that extrinsic value of the in the money put with the 84 delta. The other one is buying the at the money, or the very close to, as close to where the underlying is trading, and then finance or sell an out of the money put with that to help finance some of that initial outlay of the cost. All right, so this is also a bearish assumption. It can also be known as a debit put spread, or it's a bear put spread. But this is with a bearish assumption on the underlying that we choose. So we don't want to pick something that we think is going to go through the roof or to the moon. Maybe you love Apple and think it's going to go straight up, or Google or something like that. We wouldn't want to do that around this strategy. We need to find something where we're kind of bearish. Maybe if the Fed doesn't raise rates, we might be looking to put this around some banks or something like that, because banks are going to be hurt by lower interest rates. All right, so with this spread, we're always going to be paying a debit. So yeah, you have to pay premium to put this on. And with theta decay, what we're going to be doing is theta decay is actually going to kind of be somewhat offset by selling that that option out of the money. So we're going to be able to try and pay for some of that theta decay, because that one's going to decay out, and that will kind of help negate some of that theta decay. And Vega, the volatility, we want to expand. The reason why we want it to expand is because anytime volatility expands, those premiums get pumped up. So, and that premium being pumped up is also holding off that theta decay from happening. So that's really what we would want to see. So we do want to put this, we want to put this in a low implied volatility environment. Therefore, the probabilities of volatility expanding are greater than it contracting. So we don't really want to see volatility contract in this. So that is a major rule. All right, so essentials to success, picking the right strikes. And this is important, despite the fact that you can just like throw a dart at the board and pick any kind of option to buy. We want to make sure that we are diligent in picking the right strikes. One is making sure that we pay for that extrinsic value that I talked about in selling that one option. And the other is trying to create, picking a strike where we are going to have a few rules around that. If we pick the one that is the 84 delta, that's the one that is in the money. That is important. The one that we're selling that's out of the money, we're paying for that extrinsic value. That's why it's really important for picking the right strikes. You don't want to do something where, especially if you're buying that in the money put, that you're not paying for that extrinsic value. That's why it's very important. And we're picking that 84 delta because, like I said, it's 1 standard deviation that's in the money, and then the one that we're selling is generally going to be right around 1 standard deviation out of the money. So that's how we're going to kind of build that. And if we're picking the one that is at the money or just slightly out of the money there, but the one that is at the money, we want to kind of make sure that one of our rules is we're going to pay right around a third the width of the strikes. And I'll go into that in more detail, but just as an easy scenario, say for instance the strikes are $1 wide, we're going to pay no more than 33 cents for that. If we're doing the one that's the 84 delta, that's the one that's in the money and we're paying for our extrinsic value with the one that's out of the money, we don't want to pay more than 50% the width of those strikes, okay? And that is really important. So, all right, picking the right duration. Now, I talked about theta briefly earlier on, and the duration of this is going to be somewhere outside of 35 days, because, and actually even outside of 45 days to be quite honest, but at least outside of this 35-day period, because this is what happens with theta decay. It really starts happening rather quickly, and this is going to be important especially for the one that is at the money and out of the money. And you know, when we pull up the platform, it'll be a little bit easier. So especially if you're picking the at the money, you don't want to pay a lot for this. You're paying for all extrinsic value, so you're going to see a lot of theta decay happening. So you definitely want to go further out in time for that particular strategy. If we're doing the 84 delta one with the paying for the extrinsic value, there isn't going to be this theta decay happening because we paid for all that extrinsic value. Okay, so keep that in mind. That if we paid for the extrinsic value, there's no real theta decay, because the one that is out of the money is going to decay as well as the one that is in the money, and since we already financed that, it's not a real worry. All right, and picking the right environment. I mentioned this again before. We want a low implied volatility percent. That means we want something less than 30% on our IV rank. So, and I'll go into showing you that whole thing here also, but we want to have a low implied volatility percent of under 30. And we want to pick the right underlying. Keep this in mind. Anytime you're doing options, for that matter, I don't care if you're just buying options or selling options, or especially the more legs there are to this strategy, you need to have a tight bid ask. And one of the rules of thumb I have here for this is anything under $100, I want that bid ask to be no more, right there at the money, no more than 10 cents wide. So keep that in mind. The ones that get deeper in the money, like those 84 delta strikes, are going to be a little bit wider, but we're going to look at the ones that are at the money or just out of the money for that relationship. We want that bid ask to be tight, because those ones that are in the money, if there's that much participation on the ones that are out of the money and it's tighter than 10 cents, those ones that are in the money are probably tighter than what they look like. We used to call it on the floor, those guys are in the weeds. It means they're not actively bidding for it, but if you just better the bid by just a little bit, somebody is likely to come in and hit you on it. All right, and know your exit strategy before entering this trade. One thing I always champion is making sure you guys stay mechanical and execute on those mechanics. So for instance, the one that is where we're buying the at the money and selling the out of the money one, because that is the 16 delta, that means that there's only a 16% probability of the underlying trading down to that short strike. So if that happens, we've beaten the probabilities, and therefore that's when we're going to exit this strategy. As soon as my short put is touched is usually when I'm going to exit that, and I don't really play around with that too much, because the likelihood is that it could go back the other way, and you know, I've given up my profits there. So the idea is here, as soon as your short strike is touched, that's when we're going to look to exit that strategy. The other thing is, if we're picking the 84 delta strike and financing it with the out of the money put, financing that extrinsic value with the out of the money put, we're going to look to cover this when our debit paid is 33% greater. So for instance, so basically what you're going to do is take your premium that you paid and multiply it times 1.33, and that's the premium we're going to be looking to exit out of. I'm never looking to take these all the way in to expiration. Like I said, the probabilities are not with us when we're doing a debit spread here. The probabilities are against us, so if we can beat those probabilities consistently, that's what we're going to try and do. So that's how we're going to do that. So multiply your debit paid by 1.33, and that's our target for our exit on this strategy. Does that make sense for everybody? So if we pay $1 for it, we're going to exit when it's trading at $1.33. Something along those lines. Okay? All right. So our max profit is going to be our long put minus our short put minus the net premium paid. So that's going to be our max profit. And we're not going to go for that max profit. That's just an understanding as to what our max profit is. I'm never going to try and squeeze that whole thing for a max profit like that. Maybe if this market just completely gapped down like hugely, then I think about holding it a little longer, but I would say that is a very, very, very rare occasion. And our max loss is going to be that premium paid. Keep in mind that any time we are paying a net debit for any strategy, that is the most you can lose on an option strategy. And then our break even is going to be that long put minus that premium paid. So the beauty of picking the 84 delta, the one that's in the money, and financing that extrinsic value, a lot of times we are going to have our break even slightly or right at where we're trading or slightly below it. So that's the nice thing about that. If you're doing the one that's the out of the at the money long put there, then your break even is going to be much lower than where we're trading. So keep that in mind as well. So you have to move a little bit further in order to achieve your break even. Is it better than a back ratio spread? I'm being asked. I would not say that it is better than a back ratio spread because I have a tendency to like to try and collect credit. But in this in this environment that I'm talking about, then I would say that yes, it is, because if volatility expands and you're short that extra put, then that's going to hurt you. One beauty about this strategy is being puts. Usually volatility expands, you guys, as the market goes down. So anytime, other than, let's say, gold has a tendency to have volatility expand when it goes up. But it's, it's the exception to the rule. But when equities or ETFs go down, then volatility will expand, and that will help us achieve our profit target much quicker. And if I'm more bearish, should I buy the out of the money or the at the money put? Larry's asking. Yes, great question. The more bearish you are, absolutely. Then you're going to be paying a lot less. So that's a caveat to this one also. If you're just kind of slightly bearish and you think it's going to just kind of meander down, then I would pick the 84 delta because you don't really have to worry about that theta decay happening. If you think that this market is maybe topping out and looking to drop rather quickly, maybe after a 10 or 20% move to the upside rather quickly, and you're looking at, hey, this is really overdone to the upside. Some of these longs have got to start to want to cover and take profit, see a bit of a correction happening, then that's probably when you're going to be picking something maybe that at the money put. All right, so let's pull up the platform here. And this is usually about the time where I start telling you guys, throw out some different strategies that, or sorry, different underlyings. I don't care what it is, and we'll run it through the rules because I think that that'll make it stick a little bit better. I think people have a tendency to learn a little bit better as you work through the process, and we'll go over it a little bit more. One of the things I'll point out here is something like American Express trading $60. You know, you can see this is a tight bid ask. It's well within inside that parameter of 10 cents. Another thing with this strategy is, you know, I look at the width of these strikes as a ballpark. Usually will work with these rules is, you know, your width is about 10% of what that underlying is trading at. And what do I mean by that? So like a $100 stock, you're going to be looking at like $10 wide strikes. A $10 stock, or maybe even a $20 stock, you're going to be looking at $1 wide strikes, just as a ballpark figure. Do you have a better chance of, with this strategy, of making a profit with an individual stock or ETF? I don't think that there is a better chance with either one, no. I think that it's the probabilities are going to equal the same. All right. Out of the money put, is this a gamma play? Yes, it can be a gamma play. Gamma is you know, going to affect the ones that are at the money more than they are the ones that are out of the money. So yes, that will, it is a gamma play for sure, especially when you're picking the one that is the at the money, because the gamma is more for that, for sure. And the 84 strike, so here's another thing. With this 84 delta, of course we don't have an 84 delta for this, so I would opt for the one that's closest to that 84 delta. This is going to act like a scenario where you have gotten short the underlying stock, and then you have bought a call to protect that side and then sold a put on the other side. So it is a play kind of like that, but a lot cheaper and a lot less margin. All right, and we don't have the November contract for American Express. It's got a good IV percent. That's this. That means it's in the lower end of its range. If we look at the chart here, you can see we don't want it when it's way up here. We would like it when it's down here because it will have a tendency to revert to the mean. And one question, a good question, is do we have to worry about earnings? Yes. One thing with the earnings is as we get in closer to earnings, we're just kind of getting past earnings for the most part, you'll see volatility start to expand. So if that will help us, right? But we don't want to take this through earnings, because after earnings you can see the spike down afterwards, and that can hurt us. We could be directionally right after the earnings, but all of that theta comes out all at once, and as Vega is kind of like a balloon, and it holds up theta. And as volatility comes out, that theta comes out real quick. So, and all the premiums, you know, decay fast. So, if you're going to do this heading into earnings, I would suggest covering this before earnings, before that announcement, unless you're completely wrong and you're basically at a max loss or something like that on this. So that would be the only time I hold that through earnings. Another caveat to that is with the dividends, you do have to worry a little bit about dividends. It's going to actually drop the price of those of the stock, so that it's going to make your price go down more. So that will help, and it will also be offset by the other put. So it's really not going to affect it so much. All right, so a couple people throwing out there. Google. You want Google with the L, right? Alphabet. All right, so they've already had a bit of a correction, and one thing with Google is I'm always scared to sell Google because it seems like it's taken over the world. Google, Amazon, those are two stocks I'm always scared to get short. But they've already had a bit of correction. One, you know, it's not really a rule, but a rule of thumb, I guess, if you will. I would like to see something like a big move up and then, you know, a 10% or greater move up the upside before I would try and do this. And one thing about this is you're going to pay a lot of money if you're trying to pick that 84 delta in Google. I'll even have to expand these for that one. So let's go to 30 just to throw it out there. And Google 84 delta, so 80, you know, it would be a pick 'em right here between those two. And you're going to probably pay a lot for it. So this is what I'm talking about. One thing to figure out is what is the extrinsic value of this option price, right? If it's the 850 put and this is trading at $56 or 50, right, mid-market is right around 57.15-ish, right around there. How do we figure out what the extrinsic value is? Well, the difference between this premium and this right here, you subtract it out, and that you subtract the 56 from the 850, so that would bring you down to around 790, right, ish. Well, then you subtract that from there and you figure out what the extrinsic value. A cheat or a floor trader hack is basically you take this strike right here, look at the corresponding call. You can do it if you're looking at calls that are in the money to the corresponding put, but since we're talking puts, look at this one and go straight across to the call side, and right around $4 is what the extrinsic value is. So the corresponding calls tells you what the extrinsic value of the puts are. Okay? All right, so that's a little floor trader hack. So if we were to do this with the in the money puts, we're going to buy the 850 puts, and then we need to finance that extrinsic value with this to stay with the rule of thumb. So we've got to try and at least get $4.30 some odd cents. So we're going to look at the corresponding put that would pay for that. And we've got to pay for $4.30, so we can go all the way down to the 730 strike, probably to be safe, the 735 strike. And you can see we're paying a lot for this, but if you were to short the stock, you're going to have a lot more margin than that. And the next step is to go and figure out what the width is, what we're paying for it, to make sure we're you know, paying a fair amount, which is 50% the width of those strikes. So 735 to 85, that's going to be 115, right? So I can do the math and tell you that's close, but just so if the strikes are 115, we got to divide that by 2. $57 would, so that's under 50% the width of the strike, so that makes that work. Okay. Yes, Brad saying you can select extrinsic value as a column in TOS. Yes, you can. But that's a floor trader hack, and rather than, you could add that to it, but you know that gets a little. I like looking at the Greeks. So yes, you can do that to make your life a little bit easier. But it is, you know, very close by just looking over here. It's a little bit harder when it's this wide, but usually when they're, you know, a couple of pennies wide, you can easily tell what it is rather quickly. So, and if you don't have TOS, that's a great way to check it out. So if we just even went to do the confirm and send on this, it'll tell us that our break even is 797. So that our break even is above where we are currently trading, right? So 797.75, so it's almost $1 below where we are trading currently. So that means we are already achieving our break even for that. So that's why it's important to pay for the extrinsic value. Because we're bearish, we want it to go down. Our break even's above us, so we're already at break even. So the other thing is to look where the underlying is trading. And on this one, I would probably pick the just out of the money if I'm bearish on this, because it's really closest to where the one is trading. Can you please do Tesla, which is much cheaper than Google? Yeah, not a lot of people want to pay that much money and for something like this. So let's look at a different example. All right, so let's look at a couple people threw out Tesla. Even Tesla is going to still be not super cheap. So let's look at Tesla though. So if we're going to look at the 83 delta, these deltas are wanky because of the way the markets are right now. Let's see, do they even have the November? They don't. They do have the November. So let's just go for the one that is just out of the money for this. And so we're going to do the 95 strike. And like I said, it's a $200 stock. So we're going to start at looking at $20 wide, because usually that's going to work it out for us just to save you a couple steps. And oops, I sold both of them. Oops. Sorry about that. Let's buy the 95 and $20 wide. We're going to sell that one. So it's $20 wide and we're only paying $8. So that is, we would expect to pay $10. So that's under, but it's not actually with the ones, the ones that were out of the money, we want a third. So if it's $20 wide, we don't want to pay any more than $6 and like 60 some odd cents. So that's not going to fit it. That's well over our parameters for a third the width of the strike for picking the one that's at the money. So remember, if you're picking the 84 delta and financing it, you're doing 50% the width or 50% the width. And if we're doing the at the money, we need to pay less. So we need to pay 33%. So that one doesn't fit. John, good question. He's asking why a third on the one that's at the money? Because our probabilities of success on this are much less. So we don't want to pay a lot for it. We don't want to pay more than a third because we are likely to not achieve our goal on this. And the more you pay for it, the harder it is to get to that profit potential. All right, so keep that in mind. Yes, and theoretically, if you pay more, you increase your probability of success. Yes, that's true, and that's why you're paying. The probabilities of success with the ones that are in the money are greater, and that's why I look at it like, yes, then that's actually worth paying more for it, because your probabilities of being in the money are greater. But with this, I don't want to pay a lot for it, and we also are, keep in mind, we're not looking for the max profit necessarily on this. We're looking to have it achieve our goal of touching our short strike. And with this one thing with Delta, it's another trader hack also. So the Delta, the 175 strike is 26. So what the definition of Delta is basically, for every dollar move in the underlying, the Delta tells you how much the premium is going to change. But on the floor, we looked at Delta as probabilities. We didn't really look at it as how much our premiums were going to change. We looked at it as probabilities, and it holds true. So the probability of the 175 strike being in the money in the next 77 days is 26%. So there's a 25% chance of that being in the money at expiration, which is not a very strong probability, right? So our probabilities are less here for that to be achievable. But the reason why I said you cover this as soon as the market comes down there and touches that, our probabilities of this strike being tested is 2 times that delta. And that's just a floor trader thing that really holds true. I mean, it's as sure as the probability of being in the money as well. So our probability of this coming down and touching that is 52%. So we've got a much better chance of it coming down and touching that than being in the money at expiration and getting that full width of our max potential profit. So keep that in mind. We're playing the probabilities here, right? So we want to cover this as soon as it goes down there, and you're not going to get your max profit on it, but that's going to be where we're going to cover this. How long would you hold on to the spread if it's not working out? I will hold on to the one that's the 84 delta much longer than I will probably hold on to the one that's in the money. And all of this really comes back to what your risk parameter is. I probably have a higher risk tolerance than some of you out there. So a lot of times, if my theory changes on the underlying, then I'm going to get out of it immediately. I don't care whether or not how much I've made or lost on it. If I start my mind, some news comes out or something like that and changes my mind, I'm getting out. Pull the plug. Don't just pull the ripcord. Don't stick with it. Don't talk yourself into it. Another way to look at it is, as soon as you start thinking, should I cover this? Then that is likely the time you should be covering it, okay, or getting out of it. Another way to look at it is a 50% loss on this, so it goes from, this isn't a good example of it because we need a third, but say for instance we did pay that, it was only the $6.60, which would be the third the width. So if I want to make this example correct, at $3.30 is probably where I'm going to look to cover this. Okay, so when I've lost 50% of the debit paid, then I'm going to cut my loss. So that's another way to look at it. Depends on your risk parameters on this, though. But stick with the, the profit side. The advantages and disadvantages of buying the 84 delta versus the 80 delta. That's a good question. When you're doing the 84 delta, you are going to be able to make the width of those strikes wider because you're going to be paying less. The deeper in the money you go, the less extrinsic value there's embedded in there. So it's going to have to be tighter, and it's going to be a little bit more difficult to pay for that extrinsic value. You're going to have to make it much tighter, and it doesn't always work out to be the 50%. Okay. All right. So let's look at somebody else had one, SPY. It's a good one, and this is actually, SPY is a good one, especially if you have a portfolio of long stocks, because you want to be able to pay or protect on the downside. So this would be something that would be a great one for somebody that is getting into options trading and has a portfolio of long stock. So you can definitely do that. If you use SPX and if you use SPY and you're used to trading most options, and you're doing maybe say 10 lots or something like that, if you use SPX, then you would want to do a 1 lot. So keep that in mind as well. And here, I'm going to go, I have 130 of these, that's why. All right, so this is going to give us the November contract. If you want to know the ARB for NOV, you just touch your nose. That's how you say NOV when you're ARBing. So we can look at this as the 83 delta. It's a pick-em between those two. I like to pay less, but so I'm going to go with the 83. So we're going to buy that one, and then we have to pay for the extrinsic value, so ballpark is going to be around 50 cents. So I'm going to be able to go a lot more. Let's just do all of them. So 50 cents, I'm looking for the one that's 50 cents, and it's way down here, which is nice. So I'm going to round it up for that one. So now we have to figure out what our width is. So we've got 15 and 28, so that's 43. So 43 wide is easily achievable there. That's actually a pretty good one. Now our chances of it coming down here and hitting that are very low. Keep in mind. Let me make sure I picked the right one. So I picked the 28. Okay, yeah, so 50 cents is about the extrinsic value. Let me just double check it, subtracting from the 28, $10, yeah. We can even look at this. So if we look at this for our break even is slightly below where we're currently trading, so that means we didn't pay for all of the extrinsic value there. So we might need to pick, say, something a little higher to get more extrinsic. So $10, so subtract 10.55 from the 28, that gives us 27.50. We're getting closer. Still slightly below where we're trading right now. Wouldn't the liquidity of some of these way out of the money strikes be an issue? Yes, especially, but with SPY it's not. I mean, as a matter of fact, here's another way to look at the we can look at volume and open interest, and those ones that are out there that I was looking at, you can even see this 85 strike, that 185 strike had 300 contracts traded today, 350. So these 2,000 traded at the 168. You know, I mean, so with something like SPY, that's why I'm saying it's so important to look at these, and that far out of the money, it's 2 pennies wide. That's awesome. There's a lot of volume and open interest going on here, and the 128's probably even had some volume. Yeah, 3 contracts, not a lot, but 3 contracts. So, and then we could even look at the ones that are just at the money. So if we're slightly bearish on this, we could pick the one that it's closer to the 118. So I usually default down a little bit. So, and it's a $200 strike, $200 one. So we're going to at least look at $20 wide, probably. So $20 wide is going to be the 98. So $20 wide, $4. That's right within our. That's well within our third the width of the strike. Okay, and if we look at what our probabilities of that happening, we look at the 198. So we got a 26% chance of the market in the next 77 days trading to 198. Okay. ER, good afternoon. All right, you select SPY, November 16, the 70 days to expiration. Yes. You know, with this particular one, when you're picking the at the money ones, keep in mind you want to default to further duration, because this whole $3.84 at the time of initiation is all extrinsic value. Now we could go closer in time to like the 49, say, if we're picking that 84 delta, and it won't have to be as wide, and we're probably not going to pay as much for that 84. The 84 delta is going to be a lot less extrinsic value, as you can see, so we can make that a little bit tighter. And since we're paying for the extrinsic value with that 84 delta put spread, the theta decay is not going to really hurt us. Yes, I know. Brad's saying you can put extrinsic value. You can create a column, an extra column over here to see the extrinsic value. I just prefer to click over there and look at it. I don't care if it's off by 5 cents or so. And if it is, usually that just means there's a dividend in those. Okay, so so keep that in mind. If you're picking the 84 delta, you can default to closer duration. It will bring in the width of those strikes. If you're doing the ones that are at the money, then I go further out because it's all theta decay, and keep in mind that slope we saw. So we don't want to see that. Extrinsic value, each side, the current price, extrinsic value, want that to negate volatility and theta decay. Sorry, choose a price, bring long, short puts. I'm not really sure what your question is there, Brad, about negating the theta decay. When we're volatility and volatility is pumped into here, but if we're paying for the extrinsic value, there shouldn't be any theta decay in that in the money option. All right, and this is being recorded. A couple of people have asked, so. Yes, it is being recorded. So another one I was looking at, I'll just throw out a couple that I was looking at also so we can go through it again. And, you know, SPY, sorry I didn't double check this, but I know SPY is low IV percent, so I haven't checked any of them. But make sure you check that, because last thing you want to be doing is doing something with a high volatility, implied volatility percent. And I go to the gearbox on TAS and add that in, because this, I don't even look at what the stock is 90% of the time. I'm looking at the IV percent before I even start with the strategy. Okay. What's better, credit spreads or debit spreads, and why? Well, I like credit spreads because your probabilities of success are higher, but there is no implied volatility that's above 50, and that's the only time I'm going to be selling credit spreads for the most part. So there's not much opportunity right now to do that. And the ones that do, like Monsanto has really wide markets, and so does Restoration Hardware. So those don't work out. So right now we're kind of stuck with paying debits, which I don't normally like to do either. All right, so but you got to take what the market's giving you, and hopefully we get some volatility expansion after we put these on. All right, so let's look at JP Morgan, because there was a couple examples here where it really worked out well, and you didn't really have to get super wide like some of those other ones. So if we looked at like the 84 delta, we got the 85 delta. That's close enough. Does it fit the parameter? It's a $67 stock, and we've got the bid ask 3 cents wide here, so that's good. It's inside of 10 cents. Yes, the in the monies do get a little bit wider, but like I said, something with JP Morgan, there is a lot of participation in these. So as you can see, these are going to have quite a bit of open interest in them. And even though there was no trade in here today on this particular strike, there's enough participation in there that people are going to be playing it. So if we're picking the in the money 84 delta, we can go a little bit closer. I did look at November for when I was betting this, so let's just go to the November ones. Actually, I had to be looking at the October for this. So let's look at the November for the out of the money one. And it's trading 87.50. I mean, that's as close to at the money as you can get, so we're going to buy that one there. And then we're going to look, you know, at least $6 wide, maybe $5 wide, would, you know, because like I said, 10%. So we're going to default to the $5 wide and sell this one. So we have $10 wide, and it's trading right around $1.48, which if it's $10 wide, it needs to be, you know, like $3. What is that? $3.20 ish. So wait, so is that right? That's really cheap. $10 wide, yeah, it's got to be three. I don't even need to do the math. I don't know why I'm second guessing myself. It's $3.30, right? So that easily fits within that parameter, and we're paying very little. You know, and what I've talked about having a move higher, one thing you can do with this is take your drawings and go to the trend line, and what it'll show you is how much that move has happened. It's close to 10% move up. One thing I look at also is this market profile, and it's time and volume basically, and it's overextended to the upside, which means all of the trades happen down here. It's pushed up. I don't think the Fed's going to go in September. That's going to hurt the bank stocks. So that's my theory around looking at this trade to go to the downside. So I really like the risk reward on this, so that's another reason why I like it. It's overextended to the upside. Another reason, and my Fed scenario. So even though it's not 10%, I think I would go with that. What about Karen? I don't know what you mean, Francis. Could you expand on that? Fifth wave move, yeah, Mark. I don't really look at that, but it very well may be, and then that means you get the ABC, right, going down. So add that to the list, right? So yeah, so all of those work out for that. And the other thing is, if we wanted to go a little bit closer and look at the 84 delta strike on this, we could pick this one by the 72.5, and then you know, we're going to look to pay for the extrinsic, which is 10 cents, 10 or 13 cents. I usually have a tendency to default just a little bit more to make our break even work out better in our favor, so that we're actually below, or the underlying is actually below where our break even is, which means our break even is higher than where we are, which is good. So we could look at it like that. We got $5.39 wide, and we have $10 wide. So it's a little bit over that 50% of what we're looking at. Just a little bit over that. So I'd probably put this on the short list, maybe even work it for a little bit. But yeah, I couldn't move that to $5 and expect to get filled on it either. So that would be close. So the other thing you could do is go out further, and let's look at the one that's the 84 delta. We don't have an 84 delta. I don't want to go to the 91 delta, so let's look at it here then. So we could buy that one and pay for it with the 30 some odd cents. I default up and look at that one. So $5, and still going to be too much. So maybe pass on that one and go for the one that is at the money for this one. Oh, am I saying that, oh, sorry, it is $15 wide. Dyslexia or something. I guess I can't even blame that on dyslexia. So it is $15 wide on that. You're right. So $15 wide, then that makes it work, because that's inside our 50% the width. Thank you for correcting me, ER. ER, you're always on it. Oh, Bobby was on it. Everybody was blowing me up. Thank you guys. Sorry. So yeah, it's $15 wide. So $7.50 would be our limit on that. So it's closer to a third on the one that's in the money. So that's a good one. That works. And our IV percent 8%, so that's good. I'm probably tired. Yeah, I probably am. As a matter of fact, I am, but no. It's more because I have a tendency to get ahead of myself and not think it, you know, I'm way ahead of myself on this and not really looking at it, I guess. So sorry about that. So $15 wide, that meets our parameter, less than 50 cents. So you could even probably play around with it and bring it in even more. If we look at this, we can look at our break even, 66.94. So that's below. Why is my extrinsic value not getting paid for here? Unless there's a dividend on it. So I would then, since we have money to play with, I'm going to look at changing this to the 60. So we can change it to the 60, and we're even, so that's $12. That's closer. So, and by doing that, if we can keep ratcheting that up, we're increasing our probability of that getting touched too. So maybe we can go to a $10. We want to go to the $10. $10 right there. There we go. That would probably be the happy medium for that, and that makes it increases our probability of success again. So play around with those too. So now it's a 44% chance of us being successful on this by it going down and trading to 62.5. Please go over the trade parameters one more time. So the 84 delta, if we're picking the one that's in the money and it's the 84 delta, we want to pay no more than 50% the width of the strikes, meaning if it's $10 wide, we don't want to pay more than $5. Now we're, you know, splitting hairs over the 4 cents here. If we're picking the one that is the at the money one, which would be the 67.5, then we don't want to pay more than a third the width of those strikes. So if it is, you know, $10 wide, we don't want to pay more than $3.33 for it. So that's on that, building that parameter. We also want low implied volatility percent, less than 30. That meets this one. The other parameter is any stock under $100, we don't want the bid ask more than 10 cents wide. And JP Morgan fits that. The reason why we don't want more than 10 cents wide, if you guys are ever implementing option strategies and there's not a lot of people in there, that means the bid ask gets wider. That means you have to give up more edge to get in and get more edge to get out, and that will hurt your overall yield on your trade. And if you continually do that, you're going to even get hurt worse over the course of time. So always stick with the, don't worry about what really the underlying, who they are necessarily. Just make sure that there's a lot of participation in there, and then build your strategy around that. And I just wouldn't go, even like Pfizer. Pfizer everybody knows about, but not a lot of people trade that underlying in the options. So I stay away from it. I love Pfizer, and I would love to buy option strategies in it, but it's hard to get in, it's hard to get out, and you have to usually give up a lot. So $10 wide, or anything. So if it's $1 wide, you want to pay 33 cents, and that's the one that is at the money, out of the money. The one that is the 84 delta, or as close to 84 delta as you can get, then you don't want to pay more than 50% the width of the strikes. Okay. And another rule of thumb is you kind of build your, on the one that's at the money, you want to go about, look at 10%, and that's where you kind of start. For some reason, had a brain fart and was going $15 wide on one of those or whatever, but you want to go about 10% width, or you know, this would be $5 or $10 wide to start with. Goldman Sachs trades great technically and allows for phenomenal option plays. Good advice, Mark. Thank you. I'm bearish Goldman. I think I actually have Goldman on right now, but I'm looking to add some more short bank stocks to get some more exposure to the downside there. All right, does anybody else have any more questions? Somebody asked me, if you buy and sell strikes that have the same extrinsic value, won't that make volatility a moot point? Yes, Brad, it does. I think I mentioned that before. It also makes theta decay a moot point. Actually, not really. I shouldn't say volatility. It makes the theta a moot point. But remember, volatility closer to the at the monies is going to affect that strike that we bought more. So as volatility goes up, it's going to affect those at the money or then in the money strikes more than the ones that are out of the money. So volatility won't be a moot point, but the theta, if we're picking that 84 strike, will be a moot point because we paid for it. Because this one, and that's why I always default to having more theta decay in a sense, because I'm selling this for the theta decay than what I paid for it. A good question. Volatility won't, because volatility, as it expands or contracts, will affect the ones that are closest to at the money than the ones that are deep in the money and the ones that are deep out of the money. So it's not going to be, it will affect you if you're picking the at the monies here. Because you can see this is more than the one we were selling. Yes, and that is why you want to do these when volatility is low, because you don't want to see volatility contract on us. We want to see it expand, because these premiums will move up faster than these will, the ones that were short, and that'll allow us to achieve that profit potential much quicker. All right, somebody asked, what was that question somebody asked way at the beginning? I said, remind me. Oh, the trading room. Yeah, give me one more second. That's right. Hold on one second. Let me go over this real quick, because we were talking about volatility a lot today and how it expands, and when it contracts, it's even more important when it contracts, because somebody was talking, they like to sell option strategies. I do too, but you have to know when is the right time and when is the wrong time to be playing around with volatility. And last week we said it was going to be the last class, but this class, there was a snafu with the link last time, so a lot of people didn't get to participate in it. So we decided to do it one more week here, and it's 50% off the normal price. This is a whole course, and this doesn't even list all of the different strategies on here. There's many more, and this is the most important thing to understand, more so than even like Delta and Row for that matter, especially Row in the environments that we've had. But this is, if you want to learn how to trade like a professional trader, this is what you have to know. As a matter of fact, when I was on the floor as traders, we would meet a half an hour before the trading day to talk about volatility, what it was expected to do, what everybody thought it was doing, what we saw happening to volatility, and then we would meet again after the close. What did volatility do? How did it affect the premiums? Where is it going to go tomorrow? That was top of mind awareness for any professional trader, is what volatility was doing to our premiums. And if you want to learn how to trade like a professional trader, this is the course to do. And especially for you guys that are some of my students, need to get this. And even if you're a savvy trader, maybe you've done this for a while, a lot of people don't understand volatility crush thoroughly enough. And at this price, 50% off, it's going to be able to pay for it rather quickly. So once this is done, there's going to be a couple guys calling you that I've worked with before. They know all about options and how they work. They'll be able to answer some of your questions. If they can't answer your question, they'll get you over to me. This course also is designed to create consistent winners and will pay for itself, like I said. And most importantly, when is the right time to sell options? When is it priced too high? How can you tell? And I even go into like how you can see in the options chain how much volatility is going to come out of those options between now and the end of that expiration. So there's a lot of little floor hacks in there. Also, you get access to the live class that we're going to be teaching here relatively soon, and most importantly, you get access to me. So if you have an options strategy that is against you, if there is a strategy you wanted to know what my rules were that wasn't covered in this course, you get access to me on that, and I will talk you through it. And if I can't do it in an email, I'm more than happy to get on the phone with you and make sure that you're building it out according to what my rules are and hopefully your risk parameters. And the other thing is you also get the daily market commentaries where I go over every trade that I'm doing, when I'm putting it on, when I'm taking it off, how I'm defending it, why I'm doing what I'm doing, and when I'm finding different underlyings to trade and why I'm doing that. So I go through all of that. I don't go maybe as much detail as what Mark was saying with the fifth wave going into the ABCs necessarily, but I will talk about like the market profile when I think something's gotten overextended and stuff. So those are like 10-minute videos I do every single day that goes through all the economic stuff that I've seen, the data, you know, like talking about the different data points that we were talking about today for the non-farm payroll, or as we used to call in Florida, the unenjoyment number, because it was always seemed to be unenjoyable day, if you will. More of a joke than anything. Everybody loved trading the unemployment numbers. So yeah, this is super important. Our earnings trade strategies, volatility crush discussed in this course, Brad, absolutely they are. And this course will help you out a lot with those options earnings trades. And I talk about the earnings trades like with Lululemon today, you know, the strategies I have. So, and you can also follow me on Twitter at Wolfman's blog, because a lot of times that daily market commentary is early in the morning. You know, I shoot it around noon, I guess, 11 or noon. So I like to put on the options strategies at the end of the day, and I talk about why and how to do that on there. So I throw those out on the daily market commentaries, what I'm doing there. Or sorry, I throw that out on Twitter, what I've done in those. Don't give the exact strikes, but you know, if you've watched the volatility crush, you know exactly where I'm at. So wish I could get it, but no money unless you have a payment plan. Bobby, I do think that they will work with you on a payment plan for this. So call them up and talk to them about it, because I think they can put that on a payment plan for you or anybody else. So I've seen that done before. 68 starting out, is this course okay for me? Absolutely, Bill. You know, it's never too late to start learning. And if you're going to start trading options, for anybody, even if you're trading options, if you're starting to trade options, you guys have to know what you're getting yourself into. And I explain all of your risks and everything else in this, so it's super important. Thanks, Eric. Always use technical details and tricks of the trade. Appreciate that. So never too late. How do we get it from Twitter? You can follow me at Wolfman's blog, and usually I'll tweet those out right, you know, at the end of the day when I put on my earnings trades. So in the chat box, look, like Bill, look in the chat box. Bobby, you can check out the chat box there. There should be a link in there. If not, you can reach out to us. I'll show you what the link is here. The link is right here. You can't really click on it, but you can go to ProTrader Strategies, find it out, or you can email us at trading@protraderstrategies.com, or call us at 310-598-6677. All right. And another thing is, you guys take advantage of this course. Reach out to me. I'm going to help you guys out. So we'll work that out with you on any of your issues and problems. And if you want like more clarification on something, I am more than happy to share everything, because my idea around all of this is the more we're educated, the more savvy traders we are, the better the markets are going to be, you guys. So we don't always going to have the, you guys may be just as good of a trader as I am, but you know, the beauty in options is it's not like one person wins, one person loses, because you could be buying a put and, you know, I'm doing something completely different, maybe on a calendar. So if we're creating tighter markets and we're all getting better at this, then that's better for the market. So I really want you guys to get in there and start making money, because we can, it's not one person makes money, one person loses money with options. It's not that way. So take advantage of it, because you've got to know volatility. I can't express that enough. Really do. Oh, trading room. Bobby's asking about the trading room. Good question. So now, what do you mean with the trading room? On that, having the live trading room session for the volatility course? Can you expand on that a little bit with the trade? Oh, what I do in the trading room? Is that on the floor back in the day? Back on the floor in the day? The trading room is basically, it's an open market. It's kind of like, you know, everybody's standing around and, oh no, that's not what you mean? You mean the live trading webinar for volatility? Oh, don't I have a daily trading room? I don't. I do the daily market commentaries where I'm talking about it. But, you know, if you're signed up for it, Bobby, you can reach out to me daily and ask me questions. I don't care. I'll get back to you. I have a no in email policy. That means that if somebody sends me an email, I'm responding. I'm not going to skip over it. So if you reach out to me, I will definitely get back to you for sure. All right, guys. I appreciate everybody sticking around. Thank you for all your kind words. Please check out that class for sure. And have a great weekend. It's going to be an extended weekend, so everybody stay safe and have a great weekend.